So this week didn't start the way we wanted to, and it'll be another 4 years until the likes of Shubman, Rishabh, Prithvi, Arshdeep, Washington, Yashasvi and others seek redemption in the plains of Africa. And while our 12-year wait for regaining the Cricket World Cup continues, the Tata Group finally brought to an end its 20-year hiatus by launching the IPO, the initial public offering of Tata Technologies Limited. The IPO opened today on the 22nd of November. It will close on the 24th, and although you are watching this video on the 25th, there is every expectation that this issue will be sufficiently oversubscribed. So Tata Tech is aiming to raise a little over 3,000 crores, and all of it will be an OFS, that is an offer for sale, wherein the company will not receive any money from this issue and the entire proceeds will go to the selling shareholders, most prominently to Tata Motors, who is likely to use this money to reduce its own debt. Now, I'll not get into IPO specifics. I'm sure as an applicant, you know the price band, lot size, shareholder reservations, etc. And I'll try and address some parts of the prospectus that we as investors need to be mindful of if one intends to stay put in the company for a longer duration and not just take advantage of listing gains. Let's start with the business, and Tata Technologies operates in the ER&D space, that is the engineering, research and development space, primarily for the auto sector. In other words, if some automobile company wants to build a vehicle from scratch, they'll call up the folks at Tata Tech to help them with the design, manufacturing and all the jing-pang that goes inside a car these days. In fact, I read this in FinShots recently that when Mr. Ratan Tata wanted to make the world's most pocket-friendly car, the Nano, he summoned 4 engineers from the Tata stable. One engineer arrived from Tata Motors, which is understandable, but the other 3 were from Tata Technologies, and that's because creating a sub 1 lakh car was more of an engineering marvel rather than manufacturing, and it required a complete redesign of the car's architecture, electrical systems, etc., which the talented folks at Tata Tech were more equipped to do. Actually, an understanding of ER&D spending is important, and globally this is likely to grow at an 11 to 13% CAGR over the next 3 years, and as cars get more modernized and regulations become stricter, I won't be surprised if this space continues for many more years. Having said this, the main trigger here is of course EV, electric vehicles, and it was way back in 2012 that engineers at Tata Tech had the EMO EV concept, and of course they would have added to that technology over the years. Come to think of it, the fact that the Tata Group has been launching new EV vehicles, cars, buses, light commercial vehicles, trucks, etc., it definitely gives Tata Tech some solid visibility in terms of future revenue. And even outside of Tata Motors and JLR, the company counts biggies like Honda, Ford, Airbus and McLaren amongst their growing roster of clients. This augurs well with the management's desire to diversify the business not only in terms of geographies, as they've already done here, but also in terms of their ER&D capabilities within the automotive sector and also targeting other industries like the aerospace sector, for instance. Okay, now in terms of financials, it's definitely a treat for sore eyes to see a highly profitable company do an IPO, and Tata Technologies has been consistently growing its top line and profits. The company reported a 42% growth in consolidated net profits at 624 crores for FY23, and more recently a half-yearly growth of 36% with its H1 FY24 profits surging to 351 crores. The revenues have also kept pace with the first half of the year, yielding 2,500 plus crores at a 34% growth. And while the analyst community has little doubt that this number will consistently increase, there are, as always, some lingering doubts, some weaknesses that the company has to address in the future. For instance, the company is heavily dependent on Tata Motors and JLR, with 33% of its automotive revenue coming from there, which means if someone has a bad year, then Tata Tech might suffer as well. Of course, this needn't be the case always, and one of its rivals, KPIT Tech, twisted the script around when it grew by around 22% between 2010 and 2018, while the top 20 car makers around the world grew by only 6%. A second niggling issue is on employee attrition, and Tata Tech lost quite a few employees last year with an attrition rate of 21.7% as compared to 11.5% in FY21. And finally, Tata Tech operates in an environment of intense competition not only from Indian players but also from global companies that are all jostling for that piece of this market that is expected to reach $200 billion in spends by 2025. Alright, we now look at the valuations, and while at the time of recording this video, it's day one of the application window, I'm sure it's the attractive valuations that will ensure that Tata Tech has a glorious IPO process. In numbers and based on H1 FY24 earnings, the company is priced at a PE of just 29 times, while its competitors in the ER&D space, KPIT Technologies, Tata Elxsi and L&T Technologies are priced a lot higher. In fact, KPIT Tech is a good comparison point with more than 85% of their revenue coming from the automotive vertical, just like Tata Tech, and with KPIT currently at a P ratio of 91, it's a case of either this company being too expensive or Tata Tech being too cheap. And I think it's a bit of both, because as I was doing my research on Tuesday, KPIT cracked 5% in early morning trade, and over time there is likely to be some parity in the valuations between these two companies. Additionally, and on a lot of other parameters like revenue, EBITDA margins, ROE, etc., the two companies are quite comparable, which makes Tata Tech's current offer an absolutely delicious proposition. So Tata Tech is one company I expect many investors and analysts to keep an eye on, and it will be interesting to see how this company shapes up outside the Tata Group framework. On its part, Tata Tech now serves 7 of the top 10 automotive ER&D spenders, has 19 delivery centers across the world, it's branching into other areas like aerospace, and even within automotives, there are tailwinds with the ACE megatrend playing out, that is automotive cars, connected vehicles, and of course electric vehicles. The shares are up for trading on the 5th of December, so if you're one of those lucky ones who receives an allotment, do use that time to measure up the long-term prospects of the company before you start bragging about listing gains. Another event that transpired this week, actually last week, was the Reserve Bank of India raising the risk weights on consumer loans. Risk weights, it sounds a bit technical, right? So let me start with the background. So the last 2-3 years has seen unsecured lending products like personal loans and credit cards grow at a scorching pace. In numbers, credit card receivables have grown at 30% per annum and is now over 2 lakh crores, while unsecured personal loans have risen by 23% and is now the second largest source of lending to individuals after housing loans. Now, we all understand that unsecured loans in any form is highly risky, as they don't come with any collateral that can be activated at the time of borrower default. And when banks and NBFCs are pushing these products at a 25-30% growth rate, which is a lot higher than the overall banking sector growth rate, it means there's a lot more riskiness in the country's all-important banking sector. It's something the RBI has flagged off on multiple occasions, but as it often is the case, these warnings have been grossly ignored by many banks and NBFCs as they continue to grow their unsecured lending book in an undisciplined manner. So obviously the RBI had to do something about this, and on the 16th of this month, they came out with a circular requiring banks and NBFCs to increase the risk weight for certain categories of lending. So what exactly is a risk weight? And in simple terms, it's the capital a lending institution has to set aside every time it gives out a loan. The risk weight is assigned for every category and type of loan, which is understandably based on the item's perceived credit risk. For instance, a secured loan like a home loan has a lower perceived risk and therefore has a low risk weight, while instruments like credit cards and personal loans have a higher risk weight. So essentially, this is a risk management tool, and per this new circular, the risk weight has been increased from 100 to 125% for all consumer credit instruments other than housing, vehicle, gold, and education loans. And credit card receivables of banks will now attract a risk weight of 150%, which was previously 125%, while NBFCs will attract 125%, which was earlier 100%. As an example, look at it this way. So let's say a bank maintains a capital adequacy ratio of 20% for personal loans, which essentially means if it wants to lend out 100 rupees, then it should have a capital of 20 rupees. Now, when the risk weight goes up to 125%, then this has a negative impact on the CAR, the capital adequacy ratio, which will now fall to 16%, which correspondingly means that the bank will have to raise more capital to maintain the same level of CAR, which will not only be a costly affair, but when it raises more capital, it will also have a negative effect on valuation metrics like the ROE or ROA, for instance. I hope you can see the pattern here, and very clearly the RBI has done this to disincentivize banks from giving loans to NBFCs, which was one rampant practice over the last 4-5 years, which is in part responsible for this mess. Actually, let me put this in numbers and it might surprise you that more than 80% of bank loans, so that's more than 14 lakh crores, actually goes to these NBFCs. So tighter norms means that the banks might have to either raise rates by 15 to 20 basis points to make lending viable for them, or else they'll have to slow down on lending to these segments to conserve capital, which is one of the primary outcomes that the RBI is hoping to achieve here. Understandably, either of these approaches is going to have an impact on the lending institutions, that is the banks, and more significantly the NBFCs, whose cost of capital will increase, leading to a margin compression and also a little tempering of their growth targets. In fact, on Friday, that is the 17th of November, the shares of Bajaj Finance were down 1.9%, while SBI Cards lost about 5% of its market cap. Even amongst banks, the biggest losers were the smaller lenders, and RBL did plunge by 7.8% on that Friday. IDBI lost 4.5%, and even the State Bank of India was down 3.7%. So the NBFCs have a lot to lose, and I think it's only the larger banks that have a balanced book can get some positives out of this. But when I look at it in the overall scheme of things, and because I'm someone who had witnessed an even more convoluted mess when I was working with SBI Cards in 2007, in some ways we have to be thankful to the RBI for being wide awake and aware of the systemic risk posed by unsecured lending. I just hope everything works out smoothly and our country's banking system is a lot more stronger at the end of the day. Okay, and the final segment is of course the question of the week, and this one was asked to me over phone, so here, have a listen.
Shankar sir, I have one more question. How are you using the PRC matrix when selecting debt mutual funds?
Now, the problem with this question is that I have no idea what a PRC matrix is, and if you're equally stumped, then here's a quick brief on it. Let's start with some background, and the period between 2018 and 2020 was a tough one for the Indian debt mutual fund industry, with a series of defaults coming their way. The biggest casualty was, of course, Franklin Templeton India, as they winded up 6 of their debt schemes, and which left investors like you and me very skeptical of investing in debt-oriented mutual fund schemes. As a consequence, while many AMCs have ramped up their internal credit appraisal system, SEBI on its part came up with a potential risk class matrix, a PRC matrix, in 2021, requiring all mutual fund houses to classify their debt schemes on this basis. To put it simply, a PRC matrix offers a framework to measure the maximum level of risk a fund can take, and is represented in a simple 3x3 grid format. So on one axis, we have the maximum interest rate risk, which is measured using the Macaulay duration of the scheme and is further classified into 3 categories. A class 1 is assigned if the maximum residual maturity of each instrument held by the scheme is not more than 3 years. Class 2 represents a scenario where the maximum residual maturity does not extend beyond 7 years. And class 3 is where the scheme can invest in instruments of any maturity, although this doesn't apply for safer instruments like the central and state government securities. So technically, class 1 means low interest rate risk, class 2 is moderate risk, and class 3 is obviously the riskiest. Similarly, the other axis of this 3x3 grid captures the maximum credit risk that the scheme intends to take at any point of time, and this is arrived by computing the weighted average of every instrument's credit risk value within that scheme. This credit risk value, or CRV, is based on the lowest long-term rating of an instrument, which is a score between 1 and 13, with 13 being offered to government securities, state development loans, and extremely low credit risk instruments, while a score of 1 will go to a below investment grade security. Again, this part is broken into 3 parts, with class A having a CRV of 12 and above, class B receiving a CRV of 10 or 11, and everything else that is a CRV of 9 or below is class C, which of course means that this portfolio has a higher credit risk as compared to the other 2. So this combination of interest rate risk and credit risk is what forms a PRC matrix, and each of these 9 boxes helps us understand the riskiness of that particular debt scheme. For example, if the PRC for a scheme falls on class 1 and class A, then it means the portfolio is extremely safe with very low interest rate risk and likewise a low credit risk. Case in point is Bandhan Bank's liquid fund, which has a PRC rating of A1, so class 1 and class A as per their latest fact sheet, and within the same category, Kotak Liquid Fund is at a PRC of B1, which means while its interest rate risk is at the lower end, the scheme's credit risk is at a moderate level. In a similar manner, you can do this for every debt fund scheme, with A1 being the safest, and as you move towards C3, the riskiness continues to increase. I hope now we can all understand and appreciate the idea behind the PRC, the potential risk class matrix, which is to get a bird's eye view of the risk that the investor is potentially signing up for when it comes to debt mutual funds. Now, the sad part is that the investor community, including me, have very little knowledge about this tool, and I'm afraid the AMCs are also not doing much to educate the masses. I mean, I haven't seen PRC being mentioned anywhere in those mutual fund sahi ads. Anyways, it's up to us to educate ourselves, and if you have a friend, family member or colleague who you think has very little idea on what a PRC is, then please do share this video with him or her. I sincerely hope between Tata Technologies, the Reserve Bank of India and a debt mutual funds PRC, you did learn something new today, and I would love to catch up with you again exactly 3 days from now. Until then.